Good morning, everyone. Well, this is it. It's our last lecture. Today is December 3rd. And the final exam will be, I think, next Wednesday, the 9th. Does that sound right? And I think you can sleep in. It's not at 7:30. It's a little bit later. I don't know the exact time. Is it 10 o'clock or something like that? Pardon? 10:30. Okay, thanks. So today we're just going to wrap up our discussion of options, and I want to give you an example of hedging with options. And if you look on the old final, there's a question about that. There will be a question on the final this year, too, where I give you a hedging question like you had on the second midterm. That was a cotton example, and what I'll do is I'll come up with a similar type of question on hedging, and then add part B, which is asking you, okay, instead of using futures contracts to hedge, I think you went long in that example. Let's suppose you choose an option instead. And the two possibilities will be to either purchase a put or purchase a call. I'm not going to be asking you about selling options. Those are hedging strategies, but we're not going to get into that. So it's going to be very easy. You're going to purchase a call or purchase a put. And you're going to purchase a call if you're worried about a price increase, and you're going to purchase a put if you're worried about a price decrease. And then you'll just work out the results and compare them to the outcome with the futures contract. So that's going to be a very big part of the final exam. So let's just quickly review the Greek letters we talked about last time. This has to do with the Black-Scholes formula, and it has to do with the premium. Remember those graphs I showed you last time where there was this large area that I shaded in, and that's the area where the premium could lie for a call and a put, and where the actual premium lies depends on the factors we've discussed, volatility, time to maturity, and so on. And these Greek letters come out of the Black-Scholes formula, which calculates the fair value of a premium. And the delta tells us how the premium, P is the premium price, how the premium changes when the futures price changes. If the futures price changes, the premium will change. The lambda tells us how the premium changes when the volatility changes. If volatility goes up, all premiums will rise. The theta tells us how the premium changes with time value, and you know that it's an eroding asset. So as time erodes, the premium is going to fall. And the gamma tells us how the delta changes with the change in the futures price. The delta is not constant. It's going to change depending where the futures price is. There's some standard relationships that come out of the Black-Scholes formula that are shown on this table. So for example, if the futures price increases, then there's going to be an increase in the call option premium and a decrease in the put option premium. Well, why is that? Well, a call option is a right to go long. So if the futures price increases, if it's in the money, the intrinsic value is going to increase. Therefore, the premium is going to go up. If it's out of the money, then the probability that it's going to move into the money is higher, so the premium is going to rise. And vice versa for the put option, right? Whereas in the second row, if you have a futures price decrease, well, of course, that's going to increase the premium on the put because the put is the right to go short, and if the futures price goes down, then let's suppose it's in the money, then the intrinsic value increases, and if that's the case, then the premium's going to increase. When volatility goes up, the premiums increase for both the puts and calls. When volatility goes down, the premiums decrease. We talked about the volatility being dampened now in the crude oil market, and that's lowered the premiums you'll see in calls and puts in WTI. Time to expiry, very straightforward. The further you're away from expiry, the higher the premium. We looked at that when we looked at the tables. The closer you are to expiry, the lower the premium. We can show these effects with some simple supply and demand diagrams. It's amazing what you can do with supply and demand diagrams. And here we have a supply and demand diagram, and the price is the premium. It's a premium on an option. This is an example of a call option, and this represents, the willingness to purchase options, and this represents the willingness to sell options. That's a market, you know that. We talked about the fact that the most anyone would pay for a call is the futures price. That's the maximum price. Remember when we had that shaded area where we were looking at the potential premium, the maximum price was the futures price. So that's where the demand curve will hit the vertical axis. And the supply curve is going to depend on things such as volatility. In any case, we're going to have an equilibrium where the premium is established at the point where supply meets demand. And then we ask the question, well, suppose that the futures price increases, okay? So just a few minutes ago, I showed you that table where the futures price was increasing, and I said the call option the premium on the call will rise. Well, this is what's happening, okay? This is what's happening. The demand curve shifts to the right, and the supply curve rotates to the left. Now, why is that? Well, the demand curve, the intercept is the futures price. So if the futures price goes up, the intercept's going to increase. So we moved from D1 to D2. And the supply curve, okay, so what I've drawn here is an option that's out of the money, so we're only talking about the time value. The supply curve is also going to rotate to the left, and what does that mean? It means for any given volume of options, the seller of the option is going to charge a higher price. And think of it logically, if you're selling a call option that's out of the money, let's say the call option has a strike price of $50 in crude oil, and the futures price today is $45. If the futures price increases from 45 to 47, and you're selling the right to go long at 50, well, you're going to charge a higher price because it's getting closer to being at the money, and you don't want to lose money as a seller, so you're going to charge a higher price. As a result of an increase in the futures price, the premium is going to go from this equilibrium to this equilibrium. So the premium is going to rise when the futures price rises, okay? Oh, sorry, I missed. This is volatility, okay? This is the impact on the premium of a rise in the futures price. Here's the story in volatility. With volatility, you'll also get an increase in the premium, and it's because both the demand and supply rotate. The demand doesn't shift in a parallel fashion because the futures price hasn't changed. But if, again, you go back to the example I just mentioned, you have a call option that's out of the money in crude oil, and all of a sudden the volatility goes up. Okay, there's some political tension in Venezuela, for example. Volatility goes up. If you're buying such an option, then you think, well, given the volatility, the market could move higher, so I'm going to go in and I'm going to buy one of these options because I think, maybe the price of oil is going to rise because there's a greater probability of a rise if the volatility has increased. So the willingness to pay, which is on the demand curve, is going to increase for any volume. Similarly, the sellers of the options, okay, they're trying to make a living. If volatility goes up, they're going to charge a higher price. So that's why the lambda effect tells us that higher volatility means a higher premium, okay? Then finally, we have the theta effect, which seems quite obvious as time erodes. The option sellers are willing to sell for a lower price because there's less uncertainty. And the buyers of the options, their willingness to pay goes down. Okay, so if we're talking about a crude oil call option, let's say on the June contract, and it's now December, and then we roll forward to, let's say, February, well, holding everything else constant, that premium will be less. because there's less time to maturity. Do you have a question? Sure, let me put that back up for you. This one? That's right. So volatility works both ways. The price could go up or it could go down. But if you're buying the option and it's out of the money and there's increased volatility, it simply means that there is a greater probability it's going to move in the money. So you'd be willing to pay more for it.
So the assumption is that the option is out of money?
In this diagram, yeah. I'm just keeping it simple. Okay, yeah. Because then we're not dealing with intrinsic value. Okay? Thomas, yeah.
So like what determines the demand curve to rotate or to shift?
It will shift if the futures price increases, because that's the maximum price that anybody will pay. And it'll rotate if the futures price doesn't change. Okay? That will shift it in a parallel fashion. Yeah. And go back to that diagram I showed you with the the range of premiums, and you can see in that shaded area how that premium will change when the futures price changes. Okay. So the delta is extremely important when it comes to hedging with options, or for that matter, speculating with options, because it tells us the extent to which the premium changes when the futures price changes. And I told you some time ago that if you have an option that's deep out of the money, it'll have a low delta value. And we looked at some examples in crude oil where you could buy some of those options, for a few $100s. If you did purchase one of those and the futures price increased, let's say a call option, you might be disappointed in that your option deep out of the money hasn't really changed in value. That's because it has a very low delta factor. Okay? So the delta is going to be equal to 0.5 when the option is at the money. Okay? And when it's deep in the money, then the delta is going to be close to 1. So the delta is going to range from near 0 to near 1, depending on whether the option is out of the money, at the money, or in the money. So the reason that the delta is 0.5 for an option that's at the money, you can think of that as a probability. If it's at the money, there's about a 50-50 chance that it's going to move in the money versus out of the money. Okay? So why is this important? Well, if you're speculating, as I just said, and you're anticipating to make a profit on your option, given your expectations of a change in the futures price, you need to pay attention to the delta. Because if the delta is very, very low, the futures price could change $5 or $10, and your option you don't really make any money. If you're hedging, it's extremely important, because there you're trying to offset the price risk in the spot market, and therefore you want a movement in the option part of your portfolio, the value of the option, that corresponds with a movement, profit or loss, on your spot side, on your cash side. So you have to pay attention to the delta. So if you hedge with options and you choose an option that's in the money, the delta is close to 1, that's fine. You can kind of match that up with your futures contract. But if you choose an option that's at the money, then the delta is 0.5, and let's say you want a hedge ratio of 1. In that case, then you'd have to buy the equivalent of 2 options for every unit you have in the spot market. So for example, if you're hedging 5,000 bushels of soybeans or 1,000 barrels of crude oil, and you want a hedge ratio of 1, when you go into the options market, then you would buy 2 options, because the delta is only 0.5. Because then if the price of oil moves by $5, each option will only move by $2.50. So that's why you want to hold 2. So let's spend a few minutes talking about hedging with futures versus options. So this is what you're going to see on the final exam. There's an example up on the Smart site. And I'm sure Maxime and Janet will cover it in the review session. Do you have more than one or just one review session? There's okay, one on Friday and one on Sunday. You should go to those, okay? Because this last part of the course, it's new material building on the old material. It's no more difficult than what we've already done, but it's new to you. And I know even some of the good students are saying, "Oh, this is really difficult." We'll go to the review session. You'll hear it again from Maxime and Janet, and then by the time the final comes around, you're going to feel very comfortable with it. Okay. So let's talk about hedging. So in the cash market, you're either going to have a short position or a long position, right? We've been through that. That's what we've done on the midterms. So you have to establish whether you're long or short in the cash market. And that's another way of saying, are you concerned about a price rise or a price fall, right? So if you're Cathay Pacific, a big airline, you sold all these tickets, you don't have the fuel yet, you're short in the cash market, right? You're worried about a rise in the price of oil. If you're Pemex, the big Mexican oil exporter, while you're pumping a lot of oil every day, you have a lot of oil production. The Mexican economy is dependent on your revenue. Well, what are you concerned about? You're concerned about a fall in the price of oil. So you're long cash. Okay, I think we've established that, and you know how to figure that out. So if you're short in the cash market, well, then you buy futures. I think that's what you did in the last midterm, right? If you're long in the cash market, well, then you would sell futures. You go short. Hedge with calls. If you're short, you would buy a call. Okay? Hedge with puts. If you're long, you would buy a put. These are possibilities, but you won't see them on a final, so don't worry about them too much. It gets quite complicated when you're hedging with options, and you can use options on the short side as well to hedge, but that's a little more detail than we want to get into. So we're either going to buy a put or buy a call. So if you're short futures, okay, if you're short cash, that's Cathay Pacific, you buy futures or you buy a call. It makes intuitive sense, right? You're concerned about an increase in price. Well, how would you profit in the futures market? Well, you want to be long. How would you profit in the options market with an increase in price? Well, you want to hold a call option. If the price goes up, that call is going to become more valuable. Similarly, if you're long in the cash market, you're Pemex oil, you're worried about a fall in the price of oil, so you would sell futures, because then if oil goes down, you're going to make a profit in the futures. How do you make a profit in the options market? If the price goes down, because that's what you're concerned about. Well, you would buy a put. If you buy a put and the price goes down, then you're going to make a profit. Okay? So let me just skip one slide because it duplicates what we're talking about anyway. So here's an example of long cash. Okay? You're long in the cash market. So this could be Pemex, the oil company. If they're long cash, then if the price rises, here's the underlying price at expiry. If the price rises, it goes up. Okay, that oil is going to be more valuable, so they're going to make more money for the Mexican economy. If the price falls, okay, then they're going to lose money, right? 45-degree line. That's their spot position. So to hedge, what do? They go in and buy a put. They buy a put We say the long put, it's going to be kinked at the strike price. You know that, okay? And then once it hits the strike price, then it starts to increase along that 45-degree line. So here's the story for Pemex. This is Pemex. Long cash. They own the oil. The oil are in reserves. Some of it's still in the ground. They're worried about a price fall, because if the price falls, then they end up with a lower sales price. You see up here, I've said effective sales price. It's lower. It goes down here if the futures price falls. So they move down that black 45-degree line. To hedge against that, they purchase a put option. The put option is going to cost them some money, okay? And that's the premium. You know that, okay? That's the premium. Let's say the current price is $105 and we're ignoring basis risk for the time being. So let's just say cash is equal to futures for the time being. You buy a put option with a strike price of 100, okay? And so if the price hits 100, then it's at the money. As it falls below 100, then this option is going to become more valuable. You'll see to the left of the kink, there's a 45-degree line going that way and a 45-degree line going this way. So if you add those two together, you get this flat spot. Okay? To the right of the kink, you've got the premium plus this upward sloping black line. So you just shift that black line over by the amount of the premium. And then what you have is this orange line, which is your effective hedged position. And what does that look like? What does that orange dashed line look like to you? If I just drew that line and I didn't have anything else on the page and I said, does this look like an option payoff chart? And it looks like what? Pardon? Long call. So you've created a long call, Kayla. Okay, that's what you've done. You've created a long call. And you can see that if the price goes from 105 to 100, okay, then you're going to lose $5 on the futures, right? And you've lost your premium of $2. That's $2. So 5 plus 2 is 7. So that's this point here. 5 plus 2 is 7. So you can practice establishing where this hedged position lies. So this is what you've created. You've created a synthetic long call. That's what we talked about last time. You've also created a price floor, and that price floor is equal to the strike price minus your premium. If there's no basis risk, then Pemex Oil has established a price floor of $98. That's the lowest return they're going to get on their oil. If the price goes up, you know, there's a revolution in Venezuela, the price goes up to 150, then they're going to move up this orange line and they're going to get a much higher revenue. So you can see that it's different than hedging with futures contracts, because with futures, you know, you can't have your cake and eat it too, right? You're buying insurance. If the price goes up or down, it doesn't really matter. All it matters is the basis risk. Whereas with options, you can see they're attractive to hedgers, because if the price falls, well, you've got your price floor. You've established that, $98. If the price rises, then you can have your cake and eat it as well. Because if the price goes up, you're going to benefit from the higher price minus the cost of your premium. Pardon me? I'm sorry, I can't hear you.
What's the $5?
Oh, that's just the drop in the return on your cash. So if the price is now 105, that's the current cash price, okay? And the price falls to 100, then you've lost $5 on your cash position. I'm just showing you where this point comes from. It's 5 plus 2, which is 7. You see that? Okay. 5 plus 2. Like I said, you know, you're adding these lines together. There's the 2, there's the 5, and we're down here at 7. Yes? Pardon me? What is it? What is it? Is that your question? Yeah. Okay, if you're hedging, you're trying to establish a minimum price. This is Pemex oil, and they have a lot of oil to sell over the next year. They're worried about a fall in the price of oil. So they're establishing a floor price, a minimum price that they will receive. If they enter into this hedge, then they know that they're going to receive at least $98. And that's going to happen if the price falls. If the price rises, they're going to get more than 98. It's a price floor. Okay? And the other side of the coin, if let's say you're Cathay Pacific, and you're also concerned about the price of oil, then you're trying to establish a ceiling price. Okay, if we talk about a floor price, there's also a ceiling price. What does the ceiling price mean? The most you're going to pay. The cap, most you're going to pay. Okay, so Cathay Pacific is worried about a rise in the price of oil. So their cash position is shown by that downward sloping 45-degree line, right? If the price of oil goes up, then they end up paying a higher price. So that's not good for them. So if they want to hedge with options, then they would purchase a call option, because if the price rises and you have a call option, then there's profit associated with holding that option. So here's the story for Cathay Pacific. Short cash, buy a call, buy a call, short cash. You put those two together, and this is what you get. Okay, what does that look like? If I just drew that orange dash line on the blank sheet of paper and said, here's a payoff chart to an option, what does that look like to you? Pardon? Long put. Thank you, Paul. It looks like a long put, right? There's a premium, hits the strike price. As the price falls, moves into the money, could move into positive territory. So you've created a synthetic long put. See that, Kayla? How do we get there? Well, to the right of the strike price, we got an upward sloping 45-degree line, downward sloping 45-degree line, right? You add those together, you're going to get a flat spot. To the left, this is always going to be kinked at the same price because you're adding the black line to the blue line. To the left, you've got the premium, which is $3, okay? And you've got that upward sloping blue line, so we just shift it to the left by the amount of the premium. So we can look at this and say, well, okay, if the cash price is 105 and it goes up to 109, then that's an additional $4 that we're paying for the oil, right? That's not good for Cathay Pacific if the cash price rises. And we're paying $3 for the premium, right? So 4 plus 3 again is 7. So we've established a ceiling price, which is the strike plus the premium, $112. So this 7 is a higher price, $7 higher than the current cash price. Okay, up there it says effective purchase price. So this is 7 over the 105, which would be 112, which is a ceiling price. So what Cathay Pacific has done is they're worried about a rise in the price of oil. So they've purchased this option, and they know that the most they're going to pay is $112. If the price of oil goes to 150 or 200, they're only going to pay 112. Whereas if the price falls, it goes to $50, well, they're going to end up enjoying the benefits of the lower price. So once again, you can see the difference between this and hedging with futures, where you give up that benefit. Okay, so just to recap what we're doing, we're just looking at two alternatives here. We're buying put options for protection against a lower price, or we're buying calls to establish the ceiling price. Okay, we're not going to do bullet number 2 on the final. Okay, and we establish either a ceiling price or a floor price, and for the time being, I've left out the basis. Now I want to give you a quick example where we include the basis, because obviously the basis could be a factor. Okay, could be a factor. So here's a slightly different way of looking at it. Okay. So the question is here, we've got a hedger who's concerned about a price fall. Okay. And let's just keep it simple. Let's suppose it's a soybean producer, okay, and they're worried about a price fall. So they're going to look at the put options market. Okay. So these guys here are put premiums. Okay. And the current cash price is $13.34. Current futures is $13.64. Hence, the basis is 30 cents. So now we have a basis. The basis is 30 cents. This soybean producer looks in the Wall Street Journal and says, okay, the current futures is $13.64, and I can buy these various put options. And obviously, the higher the strike price, the more expensive they'll be. So which one do I buy? Okay, which put do I buy? Well, it might depend on how strong your price expectations are, and it might depend on your desired level of protection. So there's no single answer to this question. You can't tell the producer, oh, buy the expensive option or buy the cheap option. It depends, okay? The outcome depends. So let's suppose we start with the expensive option, okay? That was the 58-cent one, okay? So this is expensive. And remember that futures are trading at $13.64. So let's consider what happens with the expensive option if prices fall or if prices rise. So that's what we're going to do. On this table, number 1 up top is the expensive option. Prices falling, prices rising. Number 2 below is a cheap option. Prices falling, prices rising. Okay? So if you buy the expensive put and prices fall by 50 cents, okay, then futures come down to $13.14. So then your net return is going to be the futures price minus the expected basis. So let's just set the basis at 30 cents. That's where it was initially when you put the hedge on. We can change that if we want to, but let's keep it simple. Just say that we expect the basis to be 30 cents. Okay, minus that expected basis. We have an intrinsic value of 56 cents if the futures price moves from $13.70 down to $13.14. That's an intrinsic value of 56 cents. And so our net return on this will be $12.82. Okay? If the price increases instead, then the futures goes from $13.64 to $14.14. The basis is 30 cents, and therefore, and you paid 58 cents, right? That was your premium, remember that. Then you end up with 13.26 if the price increases. If the price increases, then the option is worthless, right? It's out of the money. So your net return is the futures minus the basis minus the cost of the premium. So it's 13.26. So if prices fall, that's what you're trying to protect against. Your net return is 12.82. If prices rise, it's 13.26. Now let's look at the cheap option. This is the cheap one down here, right? 13.30, where the basis was 39 cents. Excuse me, the premium. That's the premium. So if prices fall, we have the same price fall, 50 cents. So futures comes back down to 13.14, just like before. We have our basis, we subtract that. We subtract our premium, and we add our intrinsic value. So the intrinsic value is less on the cheaper option. So that gives us 12.61 if prices fall. So if prices fall, we're not getting as much protection, are we? We compare 12.82 to 12.61. 12.82 to 12.61. And we're getting more protection up above. But we're paying for it. We get a higher premium. That's what we're trying to hedge against. Now, if prices rise, then we're going to probably end up throwing the option away. So if prices rise, then it's just the futures price minus the basis minus our premium. So we end up with 13.45 versus 13.26. So this is very interesting. If you tell the producer to buy the expensive option, well, then they get more protection if price does move against them, but their return is less if the price goes in a favorable direction. So one gives more protection. Up top, you get more protection if prices fall. Down here, your net return is higher, it's 13.45 versus 13.26 if prices end up increasing. Any questions on this? Yes, Thomas.
So, like, can you repeat again why we only add intrinsic value when the price drops?
Why we only add the interest?
No, intrinsic value.
Oh, intrinsic value. When the price drops? So which one are you talking about? Either one, okay. So if price drops, then you get the futures price minus the basis because you're selling in the spot market, right? You had to pay for the premium, right? So that comes out of it. And if the price drops, then this option has some value. And that's the intrinsic value, okay? We're looking at this at expiry, so I'm ignoring time value. We're just assuming you buy this option and it's going to expire around the time you unwind your cash position. Does that answer your question? Or? Okay, tell me why, what part it doesn't answer. I mean, if the thing is we're trying to insure against a price fall. By buying a put, if the price falls, then the put's going to have some value. So we account for that when we look at our net return, right? When we match that against how much we paid for the premium and how much we get in the spot market.
So like does that mean like on the other side when the price increases, we don't take that into account?
You mean down below?
Yes.
Well, it expires worthless. So you throw the option away. There is no intrinsic value. So we can't count that, right? You just throw it away. But you have to account for your premium. So the line just below that, it's the futures minus the basis, which is our spot, minus the premium, right? And the reason that it works out better on the cheaper option is your premium's only 39 cents versus 58. So you're throwing away a document that you paid 39 cents for versus throwing away a document you paid 58 cents for. So you're better off throwing away the cheaper one if prices end up going higher. Okay. Okay. Great. Yeah.
Does it mean it's like more like insurance?
Yeah, it is. So Jan's question is more like insurance. In a way it is. compared to futures.
Like you pay more and then you get more coverage.
You can choose your level of coverage. Mhm. Exactly. Okay. So let's look at an example that might appear on the, something like this might appear on the final. Something quite similar anyway. So here's a hedger's long cash. Okay, same sort of deal. And long cash soybeans, and the cash price is $13.80. And this hedger, she buys a put with a 13.75 strike for 70 cents. Okay, so we draw our payoff. The expected return, remember, is relative to the current cash price. It's relative to the current cash price. So we draw the put on the payoff chart. So she's long cash, 1380. If the price rises, futures price rises, okay, goes that way, then her soybeans are going to be worth more money, and her expected return is going to be greater than 1380. If it falls, well, we know that story. It's worth less. She buys a put option. Here's the strike price, 13.75. Okay, to the left, we've got two diverging 45-degree lines. You know that that gives you a flat spot. And to the right, it's going to be upward sloping. This is what we looked at a few minutes ago. Okay. So she's establishing a price floor because she's long cash, and she's worried about the price of soybeans falling to, $6 a bushel. She's trying to establish a price floor, and she can establish a price floor by purchasing this put option, and the floor is equal to the strike price minus the premium, which we just discussed. Okay. So I'll ask you the same question. This dashed line, what does that look like to you? Pardon? Synthetic call. Thank you. You've created a synthetic call. She's created a synthetic call. She has her cash soybeans here. Let's say the price drops to $13.75. So that's a decline of 5 cents, right? At $13.75, well, that happens to be the strike price. What did you pay for the option? Well, you paid 70 cents. So 5 plus 70 will give you 75 cents. So if that's where the price settles, then you're going to get 75 cents less than 13.80, or you get 13.05. If the price rises, it goes to 14.50, then you're going to earn a return of 13.80. It has to go that high because this was an expensive option, right? You paid 75 cents for it. So if it goes to 14.50, then you get your 13.80. If it goes above 14.50, then you're making additional profit. So once again, as Jan said, you're kind of establishing, you're choosing your level of risk, you're choosing where your floor price is by the size of this premium. And we know that if the price goes this direction, you're actually better off if you purchased a cheaper one. But if it goes this direction, then you're better off purchasing a more expensive one. Alex?
The blue line is cash.
That's cash, yeah. That's cash. Okay, any questions on this? That's good. Now, did this help? A little bit. Not a whole lot? No. Okay, I'm out of slides. So I want to talk about StockTrack for a second. I hope those of you who traded enjoyed it. There are some people who didn't trade. Not sure why, but we had at least, was there about 50 people who made money? That sounds about right. 46 people who made money, Janet, right? Okay. And in third place is Neil Segrist. Is Neil here? Nope. He must be home trading, I guess. Second place is Josh Forsich. Josh, congratulations. Josh made $279,178 in how many weeks? 8 weeks? That's pretty amazing. How did you make all that money? In the S&P? Okay. All right. First place is Kun Liu, L-I-U. Is Kun here? He must be out trading too. Well, I guess, Josh, you get a reward for being in second place and coming to class, so come on up. Congratulations. He asked one or two questions at the beginning of class, and he was silent, so I guess he got everything. And, you know, are you going to be buying lunch today?
I wasn't planning.
No? Yeah, well, that's a pretty nice return. But I have a prize for Josh, but university regulations say you have to answer a skill testing question first. Yeah. But you can use the audience. Okay? All right. So the first part of the question is, if you sit down with somebody in a coffee shop and you're telling them about this course and how much money you made, almost $300,000 in a few weeks, and they ask you, well, how do prices behave in the futures market? How would you describe? You can give them a hint. Remember I told you a story about many years ago? What?
Yeah,
You should have said roommate. A hint, Jai? Come on. Okay. Random walk. I knew that you knew that. Right? Okay. So that's how prices behave, right? Okay. In the futures market, there's two groups of traders, right? There's two groups of traders, broadly defined. What are those two groups? Very good. He didn't even need audience help, right? Hedgers and speculators, okay? Now remember I talked about Keynes and the theory of normal backwardation and risk premium and, do hedgers pay a lot of money to speculators in order to buy insurance? Do you remember that? Yeah. Did we come up with any answer as to how high the risk premium was? In other words, are hedgers paying a lot of money in order to trade in the market on balance?
I would say at the end, the speculators are losing. Is that
But you can get some audience help here. Is the risk premium of significance? Is it very large, or is it almost zero?
It's almost there.
Almost zero. Very good. Boy, the clock was ticking down on that one. Okay, so it's almost zero. Risk premium. We could say is zero. So that means the hedgers break even, right? That means they break even. And then we have the speculators. So they're the other group. So if the hedgers break even, that doesn't mean the speculators are earning large returns from the hedgers on a daily basis. So what would we say about speculators in aggregate as a group? No, this group's breaking even. So it's a zero-sum game. They must break even. Thank you. It's a zero-sum game, right? They must break even. Now there's two types of speculators, right? They're the novice traders like myself, and I don't know if Josh is in that category. And then there's the professional traders, right? These are the guys, I think I told you, some of them, they wear diamond rings that are worth more than my house. So would you say that those professionals break even? No, they don't. So they make money. So if the professional speculators make money, and the group breaks even, what does that say about the novice? They lose. Okay. So the moral of the story is, be careful out there. Don't try this at home. A little knowledge is a dangerous thing, trading. So there's a lot of truth to this, actually. So here's Josh's grand prize. It's his very own copy of Trading Places.
Perfect. Thank you very much.
You're welcome. Okay, guys, I'm going to scoot. Kayla's going to hand out the course evaluations. I'd ask you to please take some time and fill those out. They are important for our department. And I've